Most people spend their whole lives believing something about wealth that turns out not to be quite true. They believe that wealth is what rich people look like: the car, the house, the restaurant, the watch. Tonight, we are going to dismantle that belief carefully and replace it with something more accurate, more useful, and considerably more peaceful. There is nothing alarming in what follows. Just a long, honest look at how wealth actually works and what the evidence says about building it on any income. Before we can talk about how to build wealth, we need to be clear about what wealth actually is, because most people, when they think about wealth, are thinking about the wrong thing. Wealth is not income. Income is the rate at which money flows into your life. Wealth is the stock of resources you have accumulated. Assets minus liabilities, net worth, the financial position you would be in if your income stopped tomorrow. These are related, but they are not the same thing. And confusing them is the source of most financial difficulty in developed countries. The distinction matters because income is visible and wealth is largely invisible. You can see what car someone drives, what neighborhood they live in, what restaurants they go to. You cannot see their balance sheet. And the car, the neighborhood, the restaurants may be financed by income that largely disappears in consumption, rather than being converted into assets. The person who looks wealthy, the expensive clothes, the new car, the nice apartment, may have almost no net worth. The person who looks ordinary, the modest house, the unremarkable car, the packed lunch, may have accumulated decades of investment and savings that add up to genuine financial security. This illusion distorts spending behavior in a very specific way. When people see their peers consuming at a high level, they conclude that their peers have more money and that they need to spend more to match that level. But they are comparing their internal financial reality to their peers' external presentation, which may bear very little relationship to their peers' actual financial position. The research on this is striking. Studies have found that the neighborhoods with the highest rates of visible luxury spending are often the neighborhoods with the lowest actual rates of saving. The pressure to demonstrate success through consumption is strongest in environments where that demonstration is most publicly visible. Real wealth is independence, the ability to make choices based on what you want rather than what you can currently afford, the ability to stop working without financial catastrophe, the ability to handle unexpected expenses without going into debt, the ability to say no to opportunities, relationships, and situations that do not serve you because you are not financially dependent on them. By this definition, which is the definition that actually matters for how your life feels to live, wealth is not a number. It is a relationship between your assets and your needs. Someone with 500,000 euros in assets and 10,000 euros of annual expenses is wealthier in the meaningful sense than someone with 2 million euros in assets and 180,000 euros of annual expenses. The first person has 50 years of financial independence. The second has about 11 years. The wealth that the financial media, the luxury goods industry, and the social media landscape celebrate is almost entirely the opposite of real wealth. It is consumption, money that has been spent, assets that have been converted into experiences, goods, and status signals. Real wealth is the opposite of visible. It is money that has not been spent, assets that have been quietly accumulated, compound growth that has been allowed to run. If there is one number that predicts long-term financial outcomes more reliably than any other, it is the savings rate. Not the return on investments, though. That matters. Not the income level, though that matters too. The savings rate, the percentage of income that is consistently not spent. The mathematics of savings rates are stark and worth examining clearly. Your savings rate determines two things simultaneously. It determines how quickly you accumulate financial assets, because saved money is invested money that compounds, and it determines how much income you need to replace in financial independence, because high spenders need more assets to replace their spending than low spenders do. Here is the calculation. If you save 10% of your income and invest it at a 7% real return, you need approximately 43 years to accumulate enough to be financially independent. If you save 20%, the timeline is roughly 31 years, 30%, 23 years, 40%, 16 years, 50%, 12 years, 60%, 9 years, 70%, 7 years. The acceleration at higher savings rates is dramatic. The difference between saving 10% and saving 30% is not 3 times the result. It is the difference between working until your mid-60s and potentially working until your mid-40s. The savings rate is the primary lever for controlling when you achieve financial independence, far more than any investment strategy. The most important behavioral insight about savings rates is that they are most effectively set as a percentage of income, automated at the point of income receipt, before the money is available to spend, not as the residual after expenses, because expenses naturally expand to consume available income, but as the first allocation, taken off the top, automated, invisible in the spending account. Someone who automatically transfers 20% of every paycheck to a savings and investment account before the paycheck hits their spending account will maintain that savings rate through the natural variation of their expenses in a way that someone who tries to save what is left over at the end of the month will not. The behavioral difference between these two approaches, with the same income and the same intended savings rate, is very large in practice. There is a significant body of research on what wealthy people actually do differently from people who earn similar amounts but accumulate much less. The most famous of these studies is The Millionaire Next Door by Thomas Stanley and William Danko, published in 1996. The book documented the habits and behaviors of American millionaires through extensive surveys and interviews. Its central finding was counterintuitive to most people. The typical American millionaire did not live in an expensive neighborhood, did not drive a luxury car, did not wear expensive clothes, and did not appear particularly wealthy in any visible way. The typical millionaire, in their research, lived in the same house for decades, often a modest house in a middle-class neighborhood. They drove ordinary cars, often bought used and kept for many years. They were acutely aware of their spending and budgeted carefully. They saved and invested consistently over many years. Their children often did not know they were wealthy. Their wealth was entirely invisible from the outside. Stanley and Danko categorized people into 2 types: prodigious accumulators of wealth, PAWS, who had significantly more wealth than their income level would suggest, and under-accumulators of wealth, UAWs, who had significantly less wealth than their income would suggest. The PAWS were characterized by high savings rates, frugal lifestyles, long investment time horizons, and low lifestyle spending relative to income. The UAWs were often high-income, high-spending professionals, doctors, lawyers, executives who consumed most of their income in an expensive lifestyle and had little to show in assets despite years of high earnings. The research found that physicians were systematically under-accumulators of wealth. Their net worth was significantly lower than their income level would predict, and significantly lower than people in many other professions who earned less but spent less relative to their income. The pressure to signal professional success through lifestyle spending, which is particularly strong in professions with high visible income, overwhelms the financial advantage of the high income. Among the cases the researchers documented was a married couple in Atlanta, both physicians, both earning well above six figures, both driving expensive cars, both living in a large house in an affluent neighborhood. Their combined income was remarkable. Their net worth, when calculated, was less than a single year of their combined income. Every dollar they earned was spoken for before it arrived. They were, in the meaningful financial sense, not wealthy at all. They were financially fragile in a way that was completely invisible from the outside. This is the income trap at its most complete: high consumption, high income, and almost no wealth. The two doctors were not unusual cases. They were representative of a large class of high earners whose financial lives looked successful and felt precarious simultaneously. The specific trap that catches a large proportion of high earners works like this. As income rises, spending rises proportionally or faster. The new salary comes with a new lifestyle: the nicer apartment, the better car, the more expensive holidays, the restaurants where new colleagues eat. Each upgrade seems individually justified. The lifestyle becomes the baseline, and the savings rate stays roughly constant, even as income rises substantially. The specific version that affects high earners most severely is what social researchers call the expenditure cascade. As income rises, the comparison group shifts. You are now spending time with people who earn at your level, and their spending norms become your reference point for what is normal and appropriate. The professional who earns 200,000 euros per year socializes with others who earn at that level. The norms of that group are calibrated to 200,000 euro incomes, and maintaining those norms consumes 200,000 euro incomes. The antidote is the deliberate decision to save a fixed percentage of every income increase before allowing lifestyle to adjust. Not all of every raise, not an ascetic refusal to enjoy rising income, but a commitment to capturing some meaningful portion of every income increase for wealth building before lifestyle inflation can claim it all. This one decision, applied consistently over a career, produces dramatically different outcomes from the default pattern of full lifestyle absorption of income growth. One of the most important and least intuitively understood aspects of wealth building is how the compounding of small advantages over long periods produces outcomes that seem disproportionate to the inputs. Consider two people with identical incomes, identical starting wealth, and identical investment returns. The only difference is their savings rate. One saves 15%, 5 percentage points of income. On a 60,000 euro income, the difference is 3,000 euros per year. After 40 years, the 15% saver has approximately 2 million euros. The 20% saver has approximately 2,600,000 euros. A difference of 600,000 euros from an extra 250 euros per month. The difference seems large relative to the input because the compound growth operates on the accumulated advantage, growing the gap geometrically rather than arithmetically. The same logic applies to fees. A difference of 1 percentage point in annual investment fees seems trivial. On a 10,000 euro portfolio, 1 percentage point is 100 euros per year. But on a portfolio that compounds to 400,000 euros over 30 years, that 1 percentage point difference has cost approximately 150,000 euros in foregone growth. And the same logic applies to the timing of investment decisions. The investor who starts contributing 500 euros per month at 25 versus 35 does not end up with a portfolio that is 10 years bigger at the same proportional growth rate. They end up with a portfolio that is 2 to 3 times larger because the first 10 years of contributions have compounded for decades by the time both investors reach 65. The practical implication is that the most financially impactful decisions are almost always the structural ones: the savings rate, the investment costs, the starting age, rather than the tactical ones. Which specific stock to buy, whether to invest this month or next, how to rebalance between sectors. There is a persistent belief in the personal finance space that wealthy people have access to investment strategies, opportunities, or information that ordinary people do not. That wealth requires a secret, a connection, or a level of sophistication that is not available to the typical person. This belief is false, and it is costly. The evidence from the world's most sophisticated institutional investors is instructive. Pension funds, endowments, sovereign wealth funds, institutions with access to the best investment managers, the most sophisticated strategies, and the most exclusive opportunities have collectively, on average, underperformed simple passive index strategies over long periods. After accounting for fees, John Bogle, the founder of Vanguard, spent his career making a single argument: in investing, you get what you do not pay for. Returns come from the market, from the underlying performance of the businesses you own. Fees come out of those returns. Every dollar paid in fees is a dollar that does not compound forward. And over decades, the compounding of fees, the compound effect of money you never got to keep, is enormous. Bogle created Vanguard in 1974 as a shareholder-owned mutual fund company with no incentive to maximize its own profits by charging high fees. The index fund he pioneered, tracking the S&P 500 at a fraction of the cost of actively managed funds, eventually became the most popular investment vehicle in the world. His contribution was not a new investment strategy. It was the removal of a structural drag on the compounding that investors were already doing. And that removal, over millions of investors and decades of growth, has been one of the most significant transfers of wealth from financial institutions back to ordinary people in the history of finance. The simple approach? A globally diversified low-cost index fund contributed to consistently over decades within the most tax-advantaged account structures available, is not a compromise or a second-best option. It is the approach that the evidence supports for the vast majority of investors in the vast majority of circumstances. The simplicity is a feature. The complexity that the industry sells is the product, not the solution. Before we go further, something important to say clearly. This is educational content only, not financial advice. The numbers and principles discussed tonight are drawn from real research and real historical experience, but every person's financial situation is different. Tax implications vary by country and circumstance. Investment returns are not guaranteed. Any decisions you make about your own money should involve careful research and, where appropriate, professional guidance. Wealth building is fundamentally about the accumulation of assets. Consumer debt is the accumulation of liabilities that directly counteract asset accumulation. The mathematics of consumer debt and wealth building are directly opposed. An investment earning 7% per year builds wealth at compound rates. A credit card debt at 20% per year destroys wealth at compound rates at nearly 3 times the speed. The most rational financial decision for someone carrying high-interest consumer debt is not to invest alongside the debt. It is to eliminate the debt first and then invest. The specific form of debt that most systematically destroys wealth-building potential is revolving consumer credit. Credit card balances carried from month to month. Buy now, pay later arrangements that are not paid off promptly. store finance at promotional rates that revert to very high rates after the promotional period. The wealth perspective on debt requires distinguishing between debt that builds assets and debt that enables consumption. A mortgage to buy a property that appreciates and provides shelter, productive debt, with an asset on the other side of the balance sheet. A student loan for education that genuinely increases earning capacity, potentially productive, depending on the specific return on the education. A personal loan to buy a car that depreciates immediately. Consumer debt for a depreciating asset. A credit card balance carried because spending exceeded income. Pure consumption debt with no asset counterpart. The first two categories can coexist with wealth building and may even facilitate it. The latter two directly reduce net worth. Eliminating them before accumulating investment assets is not financially conservative. It is the highest return investment available. For many households in developed countries, the family home is the largest single asset. In countries with strong house price appreciation over recent decades, homeowners have accumulated substantial paper wealth through property. But this wealth has specific characteristics that make it less useful than equivalent wealth held in financial assets. It is illiquid. You cannot sell part of your house if you need 50,000 euros. It is undiversified. Your entire property wealth is in a single asset, in a single location. It is expensive to maintain. The ongoing costs of property ownership consume a meaningful portion of its return. There is also the specific danger of treating property wealth as retirement provision when it is not genuinely accessible in that form. Many homeowners in expensive markets are house-rich and cash-poor. They have substantial equity in their home, but limited liquid financial assets. When retirement arrives, they discover that converting that property wealth to income requires either downsizing with the associated transaction costs, disruption, and emotional difficulty, or equity release products that are expensive and reduce the inheritance available to children. The more balanced approach to housing and wealth building is to own property for its genuine benefits: stability, autonomy, forced saving, potential appreciation, while simultaneously building financial assets that provide liquidity and diversification. Not treating the mortgage as the entirety of saving, not assuming that property appreciation will provide sufficient retirement income. The tax dimension of wealth building deserves focused treatment, because the difference in after-tax outcomes between someone who manages their tax position well and someone who does not is very large over decades. And most of the tools required are available to ordinary people. The fundamental principle is simple. Taxes on investment returns reduce compound growth. Every euro of return that is taxed is a euro that cannot compound in subsequent years. Over long periods, this drag accumulates significantly. The primary tool for reducing this drag is maximizing contributions to tax-advantaged accounts before investing in taxable accounts. Pension accounts, ISAs in the United Kingdom, PEAs in France, RRSP and TFSA in Canada, Pillar 3A in Switzerland. These vehicles allow investments to grow either tax-deferred or tax-free. Consistently maximizing these accounts over a working lifetime produces dramatically more wealth than identical contributions in taxable accounts, purely through the tax treatment. The second tool is asset location, placing different types of investments in different types of accounts to minimize overall tax. High-yield bonds and dividend-paying stocks, which generate taxable income each year, are best held in tax-advantaged accounts where the income is sheltered. Growth stocks that pay no dividends and are held long-term are more suitable for taxable accounts. The third tool, relevant as wealth grows significantly, is estate planning that transfers assets efficiently to the next generation. In most countries, pensions can be passed outside the estate for inheritance tax purposes. Lifetime gifts, when made in advance, can reduce the taxable estate without gift tax implications up to certain limits. No financial behavior happens in a vacuum. The spending habits, the savings rates, the investment decisions, and the financial priorities of the people around you influence your own behavior in ways that are pervasive and largely invisible. The research on social influence in financial behavior is extensive and consistent. People adjust their spending to match the perceived norms of their social group. They are more likely to make investment decisions when people around them are investing. They are strongly influenced by the visible consumption choices of peers. This social influence is not primarily conscious. It shifts what feels normal, what feels adequate, what feels like enough. In a social environment where new cars are normal, driving a 10-year-old car feels unusual. In an environment where expensive holidays are normal, a modest camping trip feels like deprivation. The reference point for adequacy is constantly recalibrated by what you see around you. The specific social media dimension of this is worth naming explicitly. Social media is the most powerful comparison machine ever created. It exposes you to a curated selection of other people's consumption. The holidays, the restaurants, the possessions, the renovations, without any corresponding visibility of their balance sheets, their debt levels, or their financial anxieties. The comparison it enables is systematically biased toward generating feelings of inadequacy and spending pressure. There is a woman in Stockholm, a financial journalist who had spent years writing about money for others, who described the specific experience of deleting Instagram from her phone for 3 months. The decision was initially made for unrelated reasons. She simply wanted to spend less time on it. What she noticed, almost immediately, was that her spending impulses declined. The kitchen renovation that had seemed urgent lost its urgency. The holiday that had felt necessary felt optional. She had not become more financially disciplined. She had simply removed the most consistent source of consumption pressure from her daily environment. She went back to Instagram eventually, but she had learned something concrete about the relationship between what she consumed visually and what she consumed materially. The two were connected in a way she had not previously been conscious of. The personal finance industry sells the concept of mindset, the idea that the right mental framework is a prerequisite for financial success. This is partly true, and mostly used as a way to sell books and courses. Let me separate what is actually important from what is marketing. The mindsets that genuinely seem to differentiate consistent wealth builders from people with equivalent incomes who accumulate much less are not the dramatic, headline-grabbing shifts that sell books. The first is a long time horizon. People who build wealth consistently are thinking in decades. They make financial decisions with reference to where they want to be in 20 or 30 years, not where they want to be next month. The second is a genuine indifference to visible status. This does not mean not caring about quality of life, but they are not spending money to impress people, to demonstrate their success, or to maintain a lifestyle that is primarily defined by what others can see. Their spending is driven by what genuinely improves their lives, not by social signaling. The third is what might be called financial confidence, a genuine belief that they understand the financial system well enough to navigate it, that their decisions are informed rather than random, and that the trajectory they are on is sensible. Given their goals, this confidence is not arrogance about specific outcomes. It is a grounded sense of understanding and control over the process. What does not appear to be important in the research, despite its prominence in wealth industry marketing, is a specific motivational state. The people who build wealth quietly over decades are often not particularly passionate about money. They are systematic. They have set up structures that work regardless of how they feel on any given day. The automation, the habit, the system produce the outcomes, not the motivation. There is a version of the wealth-building message that focuses almost exclusively on spending reduction. Cut your expenses, live frugally, optimize your budget, as if the path to wealth is primarily about spending less. This message is partial and misleading. Spending reduction has a ceiling. There is a minimum level of spending below which you cannot go and maintain a reasonable standard of living. Income, on the other hand, has no ceiling. The mathematics support this. Someone who earns 50,000 euros per year and saves 20% saves 10,000 euros per year. Someone who grows their income to 80,000 euros per year while maintaining a 20% savings rate saves 16,000 euros per year. The income growth, all else equal, produces 60% more saving without requiring any reduction in lifestyle. The wealth-building framework should therefore include both spending discipline, maintaining a high savings rate as income rises, rather than allowing full lifestyle inflation, and income growth, actively investing in skills, relationships, and career positioning that increase earning capacity over time. These are not alternatives. They are complements. A man named Marcus Webb, an electrician in Birmingham, in his late 20s, spent 2 years after his apprenticeship saving aggressively while simultaneously investing in an additional qualification that allowed him to work in a more specialized and better compensated area of his trade. The qualification cost him £1,800 and about 3 months of evening study. When he completed it, his day rate increased by nearly 40%. His savings rate, which he maintained at the same percentage of income, now generated significantly more wealth in absolute terms with each passing year. His story is not dramatic, no business empire, no stock market windfall. He simply increased his income deliberately and maintained his savings rate. The combination of these two things, both entirely within his control, changed his financial trajectory more than any investment optimization could have. New car purchases on finance represent one of the most consistent, wealth-destroying decisions made by ordinary households. A new car purchased on finance combines multiple financial disadvantages simultaneously. It is a depreciating asset, losing 15 to 25% of its value in the first year. It is financed at interest, adding several thousand euros of interest cost to the total price. And it creates a fixed monthly payment obligation that reduces financial flexibility. The financially optimal approach to car ownership that the research consistently supports is buying a used car, 2 to 4 years old, that has already absorbed the steepest depreciation. The first owner has paid for the car's most expensive period of ownership, lifestyle ratcheting, where every income increase triggers an immediate upgrade in lifestyle, is the second major wealth destroyer, the mortgage that stretches to the maximum the bank will lend. The holiday upgrade, when the bonus arrives. The restaurant tier that rises with every promotion. Each individual decision is individually justifiable. Together, they ensure that the savings rate stays constant, regardless of income growth. Financial avoidance. The pattern of not opening bank statements, not reviewing pension statements, not calculating net worth, not engaging with financial planning, is a third major wealth destroyer. Not because ignorance itself costs money directly, but because the decisions that happen in the absence of financial engagement are almost always worse than the decisions that would happen with clear information. Fees accumulate unnoticed. Pension investments sit in inappropriate default funds. Subscriptions persist beyond their useful life. Insurance renews at inflated prices. Investment inaction is the fourth. Not the dramatic failure of making bad investments, but the simple failure to invest at all. Keeping savings in cash accounts rather than investment accounts. Not starting a pension because the setup feels complex. Not investing because the market feels uncertain, which it always does. The cost of inaction, the foregone compound growth on uninvested capital, is very large, over decades, and entirely invisible. You never see the statement showing what you would have had. At some point in any serious conversation about wealth, the happiness question arises. Does more money make people happier? Is there a level of wealth beyond which additional money provides no additional well-being? The most famous finding in this area came from a 2010 study by Daniel Kahneman and Angus Deaton, both Nobel laureates, which found that emotional well-being rose with income up to approximately $75,000 per year in the United States, after which additional income had no further effect. This finding was widely interpreted as establishing a specific income level at which money stops buying happiness. More recent research, a 2021 study by Matthew Killingsworth using a much larger data set, found a different picture. He found that emotional well-being continued to increase with income well above the $75,000 level, with no clear plateau. When Killingsworth and Kahneman subsequently collaborated, they found that for most people, well-being does continue to rise with income beyond $75,000, but that for a subset of people who are unhappy at lower incomes, higher income does not improve emotional well-being beyond that level. The nuanced finding is something like this. For most people, more money does contribute to more well-being through reduced financial anxiety, through greater freedom of choice, but the relationship is logarithmic rather than linear. Each additional increment of wealth produces less additional well-being than the previous increment. What does appear to generate well-being consistently regardless of income level is the feeling of financial control, knowing your situation, having a plan, feeling that you understand your finances, and that you are making deliberate decisions. This is distinct from having a lot of money. It is a relationship with your financial situation that feels competent and intentional rather than chaotic and anxious, and it appears to be available at almost any income level through the same habits and structures we have been discussing throughout tonight. The conversation about wealth building would be incomplete without acknowledging the role of inheritance and intergenerational wealth transfer. In the United Kingdom, France, Germany, and many other developed countries, the proportion of household wealth that is inherited rather than earned has been increasing over recent decades. Academic research, including the work of Thomas Piketty, has documented this trend. As the return on capital has exceeded economic growth rates, accumulated wealth has grown faster than labor income, concentrating at the top of the distribution and increasingly passing between generations. For individuals, the practical implication is that financial starting points vary significantly based on family background in ways that are not always visible. Someone who receives a deposit gift from parents when buying their first property, or who inherits a property, or who benefits from school fees paid by grandparents that reduce their own educational debt. These advantages are real and significant, and they compound over time. This does not mean that people without inherited advantages cannot build wealth. Millions of people have done and continue to do so. But it does mean that the wealth-building framework is not equally easy to implement from all starting points. The practical response to this reality is not resentment, which is understandable but not useful, but clarity. Understanding your actual starting point, including both its constraints and its advantages, allows you to plan realistically rather than against an assumed level playing field. No honest discussion of wealth building can avoid the role of luck, and most wealth building content systematically under-acknowledges it because the self-help genre requires an empowering narrative of individual control. Luck operates at multiple levels in financial outcomes. The country you were born in determines the economic opportunities available to you. The family you were born into determines your starting capital, both financial and social. The time period you were born in determines the economic conditions you entered the labor market during, the asset prices you faced when you began investing, and the regulatory environment governing your retirement saving. The cohort that entered the U.S. labor market in 1982 and began investing in equities as interest rates declined from historical peaks enjoyed 30 years of falling rates and rising asset prices that were among the best investment conditions in history. The cohort that entered in 2000 and 2001 faced the dot-com crash immediately, then the 2008 financial crisis, then a decade of low returns. Same skills, same habits, same savings rates, very different outcomes, driven substantially by timing that was entirely outside their control. Morgan Housel captures this well. The humility to acknowledge that some portion of your financial success is attributable to luck, and that some portion of others' financial difficulty is attributable to circumstances rather than choices, produces both more accurate thinking about causation and more appropriate responses to both success and failure. The controllable variables are what we have been discussing all night. They are real, they are significant, and they produce genuine differences in outcomes even for people starting from similar points. But they operate within a distribution of luck that means similar behavior can produce different outcomes, and different behavior can produce similar outcomes in ways that are uncomfortable to acknowledge and essential to understand. Let me bring everything together into a framework, the principles that the evidence actually supports for building genuine, lasting wealth on ordinary incomes. Principle 1. Wealth is net worth, not income. Focus on accumulating assets relative to liabilities, not on demonstrating success through visible consumption. Principle 2. The savings rate is the primary variable. More than investment returns, more than income, more than any tactical financial decision, the percentage of income consistently saved and invested determines long-term financial outcomes. Set it deliberately. Automate it. Protect it from lifestyle inflation. Principle 3. Time is the most powerful factor. Start as early as possible. Every year of delay requires higher contributions to reach the same destination. Principle 4. Eliminate high-interest consumer debt before investing. The guaranteed return of paying off 20% debt exceeds the expected return of any investment. Principle 5. Use every available tax advantage, employer matching, tax-advantaged accounts, tax-efficient investment structures. These structural advantages compound over decades and produce large differences in outcomes for minimal effort. Principle 6. Keep investment costs low. The fee difference between a high-cost and low-cost investment approach compounds into very large amounts over decades. Choose low-cost index funds as the default. Principle 7. Stay invested through volatility. The behavioral gap, the difference between what markets return and what investors actually earn due to poorly timed buying and selling, is one of the most consistent sources of return destruction. Automate contributions. Have a written investment policy for difficult periods. Principle 8. Invest in your income growth, particularly in the early stages of a career. The highest return investment is often in skills education, and career positioning that increase earning capacity. A higher income maintained at the same savings rate produces dramatically more wealth than the same income optimized to death. Principle 9. Housing is a consumption and lifestyle decision with financial components, not a replacement for diversified investment. Principle 10. The social environment matters. The financial norms of the people you spend time with influence your own financial behavior in ways that are real and persistent. Be deliberate about your reference group. These 10 principles, applied consistently over a working life, produce genuine financial security and, for most people, genuine financial independence. They do not require secret knowledge, special access, or exceptional circumstances. They require consistency, which is supplied by systems and automation, not by willpower, and patience, which is supplied by understanding why the process works. Let me describe as concretely as possible what building wealth actually looks like in a real life, not an idealized version, but the actual texture of it. It looks like a monthly paycheck arriving, and 20% of it disappearing immediately into investment and pension accounts before you ever see it. The remaining 80% funds a comfortable but not extravagant life. The apartment is nice, but not the nicest available. The car is reliable, but several years old. The holidays are enjoyable, but not Instagram optimized. It looks like not looking at your investment portfolio every week, checking it quarterly, seeing that it is larger than it was, and continuing with the contributions regardless of whether the market is up or down. It looks like market corrections arriving, the inevitable 20 or 30% declines that happen every few years, and feeling the discomfort, understanding intellectually why the contributions should continue, and continuing them. It looks like getting a promotion and increasing the automatic contribution before adjusting the lifestyle so that a portion of the new income is captured for the future before it can be absorbed by higher rent or a better car. It looks like declining the invitation to join colleagues for an expensive dinner, not every time, but often enough that the social spending stays within the budget. It looks like doing the annual financial review, 2 hours in January, going through every account, every investment, every subscription, every insurance renewal, checking that everything is still appropriately structured and efficiently priced, not enjoying it particularly, doing it anyway, finding something that can be improved, a fund with higher than necessary fees, an insurance renewal that can be negotiated down, a subscription that can be canceled. And it looks like decades passing, the portfolio growing from a few thousand euros to tens of thousands to hundreds of thousands, the mortgage declining, the net worth climbing, the financial anxiety that was present in the 20s gradually replaced by the confidence of knowing that the trajectory is good. None of this is dramatic. None of it makes for a compelling social media post. None of it requires a special opportunity, a secret, or a mindset shift. It is the consistent, patient, boring application of a small number of principles that work, that have always worked, that will continue to work, for anyone willing to apply them consistently over time. That is the wealth truth that most people get wrong, not because it is complicated, because it is too simple to sell. There is a concept that sits quietly at the center of most long-term wealth-building stories, and that rarely appears in the headlines because it is not dramatic enough to generate engagement. It is the concept of the financial floor, the minimum financial position from which you operate, and the way that floor determines not just your security, but the quality of your decision-making in everything that comes after. When a person has no financial floor, no savings buffer, no investment cushion, no margin between their income and their obligations. Every financial decision they make is made under pressure. The job negotiation where they cannot walk away because they cannot afford to. The car repair that goes on a credit card because there is no alternative. The medical expense that leads to debt because the timing is wrong. The investment opportunity they pass on because the capital is not there. The toxic work environment they tolerate because leaving would create a gap in income that their finances cannot absorb. Financial vulnerability does not just affect the financial domain, it spreads. Research on the psychology of scarcity, particularly the work of Sendhil Mullainathan and Eldar Shafir, demonstrates that financial stress occupies cognitive bandwidth in a way that reduces effective decision-making across all domains. People under financial pressure make worse decisions not because they are less intelligent, but because a portion of their cognitive resources is permanently occupied by the management of scarcity. The financial stress is literally taking up mental space that would otherwise be available for other things. This is one of the most important and least discussed arguments for building financial stability as early as possible. The benefit is not just the money in the account. The benefit is the cognitive and emotional freedom that comes from not being under financial pressure. The person who has 3 months of expenses saved is not just 3 months safer from disaster. They are making decisions from a fundamentally different psychological position from someone with no buffer at all. Their choices are less constrained by immediate financial fear. Their thinking is less occupied by scarcity management. Building the floor, the emergency fund, the debt elimination, the first few months of savings is not just the first step toward wealth. It is the step that changes the nature of every subsequent decision. And for that reason alone, it deserves to be treated as the highest priority in any financial plan, ahead of investment optimization, ahead of tax efficiency, ahead of everything that happens above the floor. The question of entrepreneurship and wealth deserves a careful treatment because it sits at the intersection of genuine opportunity and significant survivorship bias. And most of what you will read about it falls heavily on one side of that line. The conventional wealth narrative often presents business ownership as the primary path to significant wealth, the founding of a company that generates value beyond the labor input of its owners. And there is truth in this. Many of the wealthiest individuals in developed countries built their wealth through business ownership rather than through employment income and investment. But the survivorship bias in the entrepreneurship narrative is significant. We celebrate the founders of successful businesses. We hear much less about the much larger number of businesses that fail, approximately half within 5 years, a larger proportion within 10, and about the founders who lose their savings, their time, and sometimes significantly more in those failures. The expected value calculation for entrepreneurship is much less clear than the success stories suggest. There is a man named David Segal who founded a tea company called David's Tea in Canada in 2008, grew it into a successful retail chain, and eventually stepped away from it. His story is occasionally cited as an example of entrepreneurial success. What is less often cited is that building a retail business of any kind requires years of personal financial sacrifice. Founders typically pay themselves very little in the early years, if anything, while their business consumes capital that would otherwise be building personal wealth. Even successful entrepreneurs often discover, when they finally calculate their net effective hourly rate across the years of the building phase, that the financial return per hour was considerably less impressive than the headline outcome suggests. This is not an argument against entrepreneurship. It is an argument for honesty about what entrepreneurship actually involves in financial terms, rather than the version that appears in inspiring founder profiles. The genuine advantage of entrepreneurship is not that it reliably produces more wealth than employment. It is that, for the specific people whose skills and temperament fit it, it can produce outcomes that are not achievable through employment. Because employment income is bounded by what an employer will pay for your labor, while business income has no such ceiling. For most people, the wealth-building framework that combines high savings rates from employment income with consistent long-term investment will produce better risk-adjusted outcomes than entrepreneurship. Entrepreneurship may be the right choice for specific individuals with specific ideas, specific risk tolerance. But it is not a superior wealth-building strategy for the average person, simply because it has produced some very wealthy individuals. We have talked extensively about the mechanics of wealth building, savings rates, investment costs, time horizons, the specific habits that the research supports. Let us now talk about the emotional architecture that sustains those mechanics over decades. Because the mechanics are genuinely simple, and the emotional challenge of maintaining them over 40 years is genuinely not. The central emotional challenge of long-term wealth building is the near total invisibility of the process during most of its duration. For the first 5 to 10 years, the portfolio is small enough that market fluctuations can wipe out months of contributions in a day. The progress is real. The contributions are accumulating, the compounding is beginning, but it does not feel like much is happening. The person diligently contributing every month is watching a number that seems to respond more to market movements than to their own discipline. This is the flat part of the hockey stick we discussed in the compound interest conversation, the long, apparently unrewarding stretch before the curve bends. And the emotional response to this flat stretch is often either to give up, to stop contributing because it seems futile, or to seek more dramatic interventions, to take more risk, to try to find a shortcut, to deviate from the simple strategy that actually works. The people who navigate the flat stretch most successfully are typically those who have found a way to make the process intrinsically satisfying rather than purely instrumentally valuable. The monthly contribution becomes a ritual rather than a sacrifice. The annual review becomes a source of genuine satisfaction, not because the numbers are impressive, but because the trend is right and the discipline is being maintained. The identity of being someone who saves and invests becomes part of how they see themselves, not just a financial strategy they are implementing. This identity shift from someone who is trying to save to someone who saves is more important than it might appear. Research on habit formation and behavior change consistently finds that identity level changes produce more durable behavior change than goal level changes. The person who has adopted the identity of a saver will maintain contributions through periods of financial stress and market volatility that would cause someone who has not made that identity shift to give up. Building that identity is not a matter of willpower or motivation. It is a matter of consistent small actions that accumulate into a self-concept. Each month you contribute, you are not just adding to your portfolio, you are reinforcing the identity of someone who manages money deliberately. And that identity, accumulated over years, becomes its own form of momentum. Let us also spend some time with the specific financial life stages, because the priorities and the challenges of wealth building change significantly as circumstances evolve. And understanding the arc helps people calibrate what to focus on at any given point. In your 20s, the two most important financial decisions are starting to invest, however modestly, and avoiding the debt that would make starting to invest impossible. The amounts invested in your 20s are small relative to what you will invest in your 40s and 50s. But the time for those small amounts to compound is the longest. €100 invested at 22 is worth dramatically more at 65 than €100 invested at 35. The specific investment is almost irrelevant at this stage. Starting is what matters. The psychological challenge of the 20s is twofold. First, the amounts involved feel trivially small. €50 per month seems like it cannot possibly matter, and the temptation to wait until you have more money to invest is strong and understandable. Second, the social environment of most people in their 20s is oriented toward consumption. Experiences, restaurants, travel, the first car, the first apartment, in ways that create genuine pressure to spend rather than save. The people who navigate their 20s well financially are typically those who find a way to participate in the social life of their peer group while also beginning the compounding process, however modestly, not those who sacrifice all social life for financial optimization, which is both unpleasant and unsustainable. But those who make deliberate choices about where they spend and where they save, with enough clarity about the stakes to maintain some consistent investment contribution. In your 30s, the challenge shifts. The demands multiply. Housing, partnership, children, career development, all arriving simultaneously as income is still growing and financial resources are stretched. The behavioral discipline to maintain savings and investment contributions through this period, even at reduced levels, is what separates the households that build wealth from those that intend to build it later. When things calm down, things often do not calm down. The 30s are followed by the 40s, and the 40s have their own demands. In your 40s, career income is typically at or near its peak. The children are older and childcare costs are falling. The mortgage is more progressed. This is the decade of maximum savings capacity for most people, and therefore the decade in which financial trajectories are most powerfully set. The behavioral challenge is resisting the lifestyle upgrades that feel justified by the higher income and the reduced family pressure. The new kitchen, the better car, the more expensive holiday, each individually justifiable. Together, they consume the decade of maximum capacity. In your 50s, the focus shifts toward consolidation and transition planning. How do the accumulation choices of the previous decades translate into retirement readiness? What adjustments to investment allocation are appropriate as the time horizon shortens? These questions require honest calculation, not reassurance, not optimistic assumptions, but clear-eyed assessment of where you are relative to where you want to be, with enough time remaining to make meaningful adjustments if there is a gap. The most common and most painful financial mistake of the 50s is discovering that the foundation laid in the previous decades is insufficient, with too little time remaining to compensate through either saving or investment growth. The time to catch this gap is in the 40s, when contributions can still matter significantly. The annual financial review, done properly, is the tool that surfaces this information early enough to act on it. There is a final thing worth saying about wealth and how to hold it once it exists. And it is something the financial planning industry rarely discusses directly because it falls outside the domain of investment optimization. Wealth, accumulated over decades of deliberate discipline, creates a set of choices that most people spend their whole lives wishing they had. The choice to leave a job that no longer fits, the choice to help a family member through difficulty without it threatening your own stability, the choice to take a sabbatical, to start something new, to slow down before you had planned to give generously without calculating what you can afford. These choices are not automatic. Having wealth does not guarantee making good use of it. There are people who accumulate substantial financial resources and spend their later years in the same anxious relationship with money that characterized their earlier years. Because the anxiety was never about the money. It was about something the money could not fix. But the options are there, available to be used. For the person who has built the foundation and the person who understands during the years of building that those options are what they are actually building toward. Not a number, not a net worth statement, but a set of future choices that do not yet exist, tends to find the discipline of the building phase more sustainable and more meaningful. You are not saving money. You are accumulating future choices. And every contribution, however small, is another choice being placed quietly in reserve for the person you will be in 10 or 20 or 30 years. That person will not remember the specific sacrifice the contribution required. They will simply find, when they need it, that they have more freedom than they expected. There is a particular kind of financial conversation that almost never happens between people who know each other and whose absence is itself a significant obstacle to financial well-being. It is the honest conversation about money, what you actually earn, what you actually have, what you are actually worried about, what your actual plan is. In most cultures, talking openly about money with friends or family feels deeply uncomfortable. Money is treated as private in a way that health, relationships, and career rarely are. People who would freely discuss a difficult medical situation or a challenging professional decision will deflect any direct question about their financial position. The result is that most people navigate their financial lives with almost no real information about how their situation compares to those around them. This social silence has specific and costly consequences. It enables the illusion that peers are financially stronger than they are, because the visible signals of consumption are not balanced by any visible information about savings or debt. It prevents people from learning from each other's financial decisions, both the good ones and the mistakes. It isolates people in their financial anxieties when knowing they are not alone would be both reassuring and useful. And it makes it much harder to challenge the spending norms of a social group because those norms are never named and therefore never examined. There's a growing body of evidence that social networks in which financial information is more openly shared produce better financial outcomes for their members. Not because talking about money magically improves your finances, but because transparency creates accountability, enables learning, and disrupts the illusion that everyone else is doing fine and only you are struggling. The illusion, sustained by silence, is one of the most expensive shared myths in modern consumer culture. This does not mean broadcasting your salary or your net worth at social gatherings. Social norms exist for reasons, and some degree of financial privacy is both healthy and reasonable. It means being willing, with people you genuinely trust, to have the honest conversation rather than the performative one. To say, this is actually what I earn. This is actually what I have. This is actually what I am trying to do. Those conversations, when they happen, almost always produce something useful. A shared resource, a new perspective, a challenge to an assumption, or simply the relief of not being alone. The question of what wealthy people actually worry about is less often discussed than the question of how they got wealthy, but it is arguably more interesting and more practically relevant to people who are building toward financial independence. Research on high net worth individuals consistently finds a paradox. The financial security that wealth provides does not eliminate financial anxiety. It transforms it. People who spent their early adult years worrying about whether they could pay the rent worry, in their later years, about market volatility. about whether their investments are appropriate, about whether they have done enough estate planning, about whether their children will inherit attitudes toward money that serve them well, about whether they will outlive their assets if they live very long. The anxiety does not disappear with wealth. Its object changes, and understanding this is both slightly deflating. Wealth is not the complete emotional solution it appears to be from a position of financial stress, and liberating because it clarifies what wealth actually provides and what it does not. What it provides is the elimination of a specific kind of anxiety, the anxiety of immediate scarcity, of not being able to meet immediate obligations, of vulnerability to ordinary bad luck. This is a very significant and valuable form of anxiety to eliminate. The research on well-being consistently shows that moving from financial stress to financial stability produces a large improvement in day-to-day emotional experience. The difference between having nothing and having enough is enormous. What it does not provide is the elimination of all anxiety or the permanent resolution of questions about meaning and purpose, or freedom from the experience of loss and difficulty. These things are not financial problems, and they do not have financial solutions. Wealth is a powerful resource for solving certain kinds of problems. Knowing which problems it actually solves and which ones it does not allows people to pursue it with appropriate expectations rather than with the fantasy that it will resolve everything. This is perhaps why the most content wealthy people tend to be those who had clarity about what they were building toward, a specific kind of freedom, a specific capability, a specific form of security, rather than those who were simply accumulating as much as possible in pursuit of an undefined enough. The defined goal creates satisfaction when it is reached. The undefined accumulation does not. Let us think about something that connects the financial and the philosophical in a way that most wealth content never quite reaches. It is the question of what you are actually doing when you commit a portion of your income each month to long-term investment. You are making a bet on the future, not in the speculative sense, not betting on any specific market outcome or economic scenario, but in a deeper sense. You are betting that the future exists, that tomorrow will come, that the institutions and systems through which your investment grows will continue to function, that the future version of yourself will be here to benefit from what you are building today. This is not a trivial bet. The 20th century contained enough catastrophes, wars, depressions, hyperinflations, the destruction of currencies and institutions, to remind us that the continuity of social and economic systems is not guaranteed. Long-term investing requires a kind of optimism about civilizational continuity that is not naive, but is genuinely a choice. The people who invested consistently through the Second World War, through the Cold War, through the oil shocks and stagflation of the 1970s, through the various financial crises of the subsequent decades, made a bet each time that the future was worth preparing for. That bet has been vindicated so far across the developed world. The long-term investor in a broadly diversified portfolio of global equities who maintained their contributions through every crisis of the past century ended up significantly better off than the person who gave up and moved to cash each time the world seemed most dangerous. This is not a guarantee about the future. It is an observation about the historical record and about the kind of world you are implicitly betting on when you invest for the long term. Long-term investment is, at its deepest level, an expression of faith in human adaptability, in the capacity of economies to recover from shocks, of companies to adjust to changing conditions, of individuals and institutions to find ways to generate value even in difficult circumstances. That faith is not certainty. It is a considered position in the face of genuine uncertainty. And it has, across the available historical evidence, been the more rewarding position to hold than its alternative. The paralysis of waiting for conditions to be safe enough, which is a condition that never quite arrives. There is a woman named Janet Jagan who spent her adult life as a schoolteacher in Minnesota and who became, in the late 1990s, the subject of a short article in a local newspaper about her financial habits. She had just retired at 63, not rich by any dramatic standard, but comfortably so. Her secret, when asked, took about 30 seconds to explain. She had started contributing to her teacher's pension and a small supplementary investment account in her first year of teaching. At 22, she had increased the contributions modestly each time her salary increased. She had never withdrawn from either account. She had never tried to time the market or pick specific stocks. She had simply continued for 41 years with the same basic approach, adjusting the amounts upward as her salary grew and paying very little attention to the balances in between. When the reporter asked her if she had followed any particular financial philosophy or read any investment books, she said she had not. She had simply decided, very early, that a portion of each paycheck was not hers to spend, that it belonged to her future self, and had never revisited that decision. The reporter noted that this was essentially the advice in every personal finance book written in the past 50 years. Janet smiled and said, "Yes, but most people read the books and then continue spending." Her observation is perhaps the most accurate single-sentence summary of the gap between financial knowledge and financial outcomes. The principles are simple. They are widely known. The application is consistent and long-term, which is the genuinely difficult part. Not intellectually difficult, emotionally and behaviorally difficult. The discipline to maintain a decision made in your 20s, through your 30s and 40s and 50s, through job changes and family pressures and market downturns and the constant ambient encouragement to spend, is the actual skill. And it is a skill that can be built through habit and through system, rather than through willpower alone. Janet's investment accounts, when she retired, were not enormous by the standards of the wealth content industry. She was not a millionaire several times over. She had what she needed, and something to leave behind, and the freedom to decide each morning what to do with her time, which is, when you strip away the numbers, exactly what wealth is supposed to provide. Let us talk for a moment about financial simplicity, because it is perhaps the most consistently underrated element in the long-term wealth-building equation, and the one most actively undermined by the financial services industry. One of the most consistent findings across wealth research and personal finance evidence is that simpler financial arrangements produce better outcomes than complex ones. Not marginally better, substantially better. And this finding is counterintuitive because complexity feels like sophistication, and sophistication feels like competence. The case for simplicity in personal finance has several dimensions. The first is cost. Complex financial arrangements, multiple accounts, actively managed funds, sophisticated investment strategies, regular advisor involvement, all cost more than simple arrangements. These costs accumulate into very large amounts over decades. The second is behavioral. Complex financial arrangements require more decisions, more monitoring, and more ongoing engagement. Each additional decision is an opportunity for a behavioral error, a poorly timed rebalance, an impulsive change triggered by market noise, a complicated tax situation that leads to procrastination. Simple arrangements minimize the decision points and therefore minimize the opportunities for costly behavioral errors. The third is resilience. Simple financial arrangements are easier to maintain through life changes, job transitions, family changes, international moves, health challenges. Complex arrangements require active management that can slip when life is demanding. The automatic pilot of a simple, automated financial arrangement continues working through difficult periods in a way that an actively managed complex arrangement does not. The simplest effective wealth-building arrangement for most people is something like this. One emergency fund account holding 3 to 6 months of expenses. One pension account invested in a globally diversified low-cost index fund with automatic monthly contributions. One ISA or equivalent tax-advantaged investment account similarly invested with automatic contributions. That is everything else. The complexity, the additional accounts, the active strategies can be added only when there is clear evidence that it adds value that the simple arrangement does not already provide. Most people will find that the clear evidence never arrives. The simple arrangement, maintained consistently over decades, produces the outcomes they need. There is something almost philosophical about the relationship between simplicity and financial outcomes. The instinct that more sophisticated approaches produce better results is deeply human. It mirrors how complexity and expertise work in almost every other domain. A more sophisticated surgeon produces better surgical outcomes than a less sophisticated one. A more sophisticated engineer designs a better bridge. In finance, uniquely, this intuition is frequently wrong. The more sophisticated the approach, the more fees it typically generates, the more decisions it requires, and the more opportunities it creates for behavioral errors. The simple approach that requires almost no ongoing decisions, charges almost nothing, and can be maintained through any market condition without needing to be rethought, produces better outcomes in practice for most people over most time periods. The financial industry has an obvious commercial interest in the belief that complexity is valuable, because complexity is what it sells. Understanding that the opposite is often true, that removing complexity from your financial life is itself a wealth-building action, is one of the most practically powerful insights available to anyone managing their own finances. We have covered a great deal of ground tonight, from the fundamental definition of wealth through the savings rate and its counterintuitive mathematics, through the research on what wealthy people actually do, through the income trap and the compounding of small advantages, through debt and housing and tax, and the social dimensions of spending. We have talked about the emotional architecture that sustains long-term financial discipline, about the life cycle of wealth building, about the role of luck and inheritance, about entrepreneurship and its survivorship bias. And through all of it, the same simple observation recurs. Wealth building is not a secret. It is not sophisticated. It does not require special access or special knowledge or special circumstances. It requires a savings rate, maintained over time, invested at low cost, in a tax-advantaged structure wherever possible, combined with enough income growth to make the savings rate meaningful in absolute terms, and enough patience to let the compounding do what compounding does when not interrupted. Janet Jagan, the Minnesota schoolteacher, did exactly this for 41 years without knowing the terminology for what she was doing. Thomas Stanley and William Denko found thousands of people like her in their research. Ordinary people with ordinary incomes who had accumulated extraordinary wealth by the simple act of spending less than they earned and investing the difference consistently over time. These stories are not inspiring in the conventional sense. They do not have dramatic moments. They do not feature genius insights or perfect timing. or exceptional luck. They are simply the product of time multiplied by consistency, which is the only formula for compound growth that has ever existed and the only one that has ever needed to exist. The night is patient, the mathematics are patient, and the wealth built slowly, invisibly, over decades of quiet decisions has always been more real and more durable than the wealth that appears suddenly and dramatically in the narratives we are more accustomed to hearing. You have the understanding now. The rest is time and consistency, and the willingness to let both of those things do the work they were always designed to do. This has been educational content, not financial advice. Take care of your money, and it will take care of you. Good night.